to our talk of the tape. This remarkable run for stocks up 60% since the bull market's start. How much can we count on this rally to continue? We will ask Malcolm Ethridge. He is managing partner with the Capital Area Planning Group, also a CNBC contributor, and is here at Post 9. Welcome to New York. It's good to see you here.
Yeah, always good to see you.
I guess that's a key question, right? We're 2 years in this week. Saturday's going to mark 2 years of this bull market. How long can we count on it lasting?
How much time we got? I think that AI really is proving that it has that kind of staying power. Last year, it was the story was Microsoft. This year, the story has been NVIDIA. What's going to be the stock next year that the AI arms race powers higher and higher? That's the real question we should be asking, not necessarily will it go on.
So I guess implicit in that is your belief. It sounds like that you think mega caps are going to continue to take us to the promised land here.
Well, yes, and I think mega caps will definitely continue to take us to the promised land, not at the pace that they have the last couple of years necessarily, but I think that what we're seeing is the broadening, to use that word that we keep using, is really being impacted by AI once again, right? So you look at things like real estate, you look at things like energy, you look at materials, manufacturing. Those things are all really being powered, again, by our demand on the grid.
Let's talk about this 2-year-old bull market, because it's overcome a lot. Now, there do remain naysayers on what's happening. I don't think as many as existed before, but can you just speak to the resiliency of this market and what continues to guide it today in the face of continued noise here, there, and in parts everywhere?
Yeah, I think you're making a really good point. If you consider that rising rates were supposed to be the thing that really crushed the markets, and in the face of the highest rates we've seen historically in decades, right, the market said, I don't really care. Especially since the companies powering the market's outperformance were ones that didn't really need to borrow to invest in growth anyway, right? If you consider the cash sitting on the balance sheet of a Microsoft or a Google or an Amazon, they weren't really worried about the Fed, so they could go build these LLMs that are powering still the AI revolution that we're talking about. So now we're at a moment where we're in an easing cycle. The Fed is cutting rates, which means that the companies that couldn't necessarily invest in growth to catch up to what's happening with the trend have the capacity now to either issue debt or go borrow to invest in AI, which gives us another second leg of this AI revolution.
Do you feel like we need to reset our expectations at all on where rates are going to go from here, or the pace at which the Fed is going to continue to cut rates? I go to the minutes, which were released an hour ago. Markets pricing in a 20% probability now of no change in November, although obviously the overwhelming number is still favoring 25 basis points. But the pace of what the Fed is going to do feels like it's going to slow.
I think we have to at least brace ourselves for the idea that the Fed could decide to go slower from here, right? To your point, maybe it's still 25 basis points at the next meeting, but then it's 0 for some time, rather than assuming that an easing cycle means it's an elevator down, right? It's been an escalator up. Probably won't be an elevator down.
That's your point of view? Because, look, I remember you were one of the outliers who were saying, look, I know everybody's on the same side of the boat talking about cuts. There is a chance that they actually hike. Not that you think they'll do that now, but
right.
You were unafraid to sort of go against the grain on what you thought the Fed was going to do. I wonder if we're getting some confirmation from hearing the minutes and such that we need to really reset our expectations, not only for what they're going to do, but what the action in the bond market is going to be.
Well, I think that we have to throw out the playbook of what has worked in the past that got us here, simply because we can't look at decades of historical data and extrapolate what's going to happen going forward here, because the whole COVID pandemic cycle that we're still dealing with has been such a unique situation, right? So the fact that unemployment has been as low as it has, with interest rates being as high as they have, and that hasn't really had an impact on a bull market the way that it normally would historically. Those are two things that usually compete with each other for who's going to lead the day. I think that we just have to reset our expectations for what that means. But I do take your point on interest rates, and I look at the fact that historically, right, I have to bring this up again, the yield curve uninverting is usually the sign of things to come. And so we should at least consider that maybe the recessionary indicator that it is telling us something, and we need to position ourselves for that as well.
I mean, does it have the ability to make us further question the multiple, the price that we're willing to pay for stocks if rates remain elevated? Earnings have to live up to a pretty good expectation. Rick Reeder was on with us yesterday on the halftime report, in which he said, I feel uncomfortable at these multiples being long. I mean, there's so much cash on the sideline. It's not like he's short or bearish by any stretch, but it's starting to get a little uncomfortable for people who look at the multiple of the market and say, I think it's a little rich.
Yeah, but I think you could make that case in 2013, 15, 17, 19, 21. Like every time we have these headlines that say multiples are stretched, they're too high, you can't justify it from here, companies like NVIDIA come out and say, yes, we absolutely can, right? And so I don't think it's necessarily a case where we look at the multiples alone, but I do think what's happening, where we were talking broadening before, what's happening is the market is coming, earnings estimates for the rest of the market are coming up to meet the Mag 7, not the Mag 7 decelerating and coming down. I think FactSet is looking at 2025 earnings estimates now are at like 17.5%. The rest of the market is roughly 1% basically for the same time period. Well, that's actually an increase from January 2023, I think, when the bull market first started. And so you have to consider that the broadening is everywhere else but tech. But tech is not slowing down to meet that broadening happening. So I understand the argument on multiples, but I don't necessarily think that it is indicative, once again, of the market that we have today.
Let's talk about some of these mega caps that you own.
Yeah.
Amazon, I want to start with, because there's been several downgrades of late. Stock was down like 8 of 9 days. It's had a bit of a rebound for a couple of those days. But are you concerned about the near-term trajectory of that stock?
I'm not. I think it's a big mistake to be selling off Amazon here. I think one of the things that's being underrated right now is that advertising business that lives inside of Amazon, and it's sort of the third most important player if you just consider what we normally talk about, AWS, retail, and then advertising. But again, AI, if we think about the power to generate advertising using AI and how much that improves the margins that already were really nice to begin with, north of 50% estimates say, we have to consider what that means for a company like Amazon that has all of that data on what you and I love to buy.
I feel like Microsoft is another one we need to talk about, because it's kind of quietly underperformed, and reasonably dramatically so. It's gotten downgrades. There are notes about OpenAI losses that are going to be absorbed by Microsoft. As I asked one of our guests yesterday, we gave all the love on the way up because of OpenAI. Now, do we need to maybe take a step back and think about the lack of profitability for OpenAI, Microsoft's investment in it, maybe what the road looks like towards profitability, and what ultimately it's going to mean for the stock, which is only up 3%, not even, over the last month, compared to, let's say, Meta, which is up near 17, NVIDIA is up near 24.
Let's consider the fact, though, that Microsoft invested $13 billion, roughly, credits and everything else that made up that number. And in return, they received about $1 trillion in market cap. I would take that bet all day, every day. And so I take your point that quietly on the way down, we're not hearing as much noise. And I think that they do need to clean up what their relationship with OpenAI is going to be, right? They rejected the board seat that they once wanted. Apple also decided we don't want to touch it either. We don't want the DOJ scrutiny. But I think that figuring out what OpenAI is going to turn itself into from here, post this last funding round, is going to help Microsoft figure out its own path forward. It's definitely been a bit of a distraction and not the helper that it was throughout 2023.
All right, let's broaden our conversation now. Let's welcome in Mike Rohde of American Century Investments and Allie Flynn Phillips of Overmeyer Wood. It's great to have both of you with us. Allie, I'll ask you first. Presumably you heard our conversation. We have new record highs on the S&P and the Dow Jones Industrial Average today. What is your outlook moving forward?
Well, first, Scott, thanks for having me. We remain cautiously optimistic. It's really nice to see in terms of increased breadth in the market. Earnings remain strong, and we feel the economy is going to have somewhat of a soft landing here. So for us, in terms of staying invested, focusing on high quality, and focusing in terms of on those companies with great fundamentals for that long-term cyclical trends, is the way to stay positioned in this market.
Mike, you know, I remember many conversations that we've had on the way up. As I said, we're marking 2 years of this bull market. Are you bullish? Are you not? What's your outlook?
Yeah, I'd say we're bullish on fundamentals. We struggle a little bit more with valuation. I recognize Malcolm's point, but large growth in the Magnificent Seven look pretty expensive, priced for perfection, I think. And there are other areas, whether it's the S&P 493, mid caps, small caps, where you're seeing that acceleration in earnings, and you're not paying for it as much as you are in large cap growth in the Magnificent Seven. where there will be a slowdown in earnings. So I think there are areas to go where you're not overpaying. There are some good and improving fundamentals driven by whether it's the yield curve steepening, whether it's like AI expanding out from NVIDIA and helping utilities and other companies, or whether it's reshoring, bringing back manufacturing to the U.S. There's a lot of really positive tailwinds that are happening in the U.S. economy. And so, but I think you do have to be aware of where valuation is and try to go to areas that maybe haven't priced in such a perfect outcome.
I feel like, Mike, maybe one of the principal lessons of this bull market we'll look back on and say that valuation will prove to be that one thing that some look to overplay, that it made people uneasy on the way up. At several times along the way up, it was, man, those stocks they're too expensive. They're well above their historical averages, for example. And here we are. Here we are, marking new highs. So if you've used valuation as a reason to sit on the sidelines, you've watched the party go by.
Oh, for sure. I would hope that folks are not on the sidelines. But, you know, in the moment, valuations can look, you know, when you look at fundamentals and look at stocks, there's that fear of missing out and you want to chase and you think things are going to continue to get better forever. You extrapolate today's results out into the future. But the reality is over 100 years of investing, valuations are probably the biggest driver of long-term returns. So we believe valuations are important, whether you're investing in growth or value. And on the other side, the more important thing is, less important is the absolute earnings growth rate. It's more the direction. So when you're getting acceleration and improvement, that typically leads to alpha generation. There's some areas in the market today, like whether it's housing or on the consumer side, boats and RVs, you know, those groups are down 50, 60% from the peak. And we might be bouncing along the bottom and things looking to potentially improve on lower rates, on a better economic outlook. And so we think there's opportunities in areas that haven't kept up and may not be as hyped as some of the Magnificent Seven stocks have been.
Ali, where's the best value in this market right now?
So first, I'd say on AI, so many people talk about, you know, the hyperscalers or the chip designers, but the key thing is really looking at the companies that are taking AI to benefit their overall businesses. They're creating great efficiencies and wonderful competitive economic moats. Look at something like Walmart that's using multiple language models to improve their catalog. Or look at Deere that's using it to improve in terms of how you're doing pesticides and things such as that. So these traditional companies that are using technology to improve, that to us is great value. Other thing is probably the housing sector. I mean, we're going to finally see an improvement in housing. Something like a Home Depot, they're going to really improve in terms of when people are repairing those older homes, buying the new appliances and hiring the professionals. So while we agree technology is doing well, broadening the scope and actually looking at some of these other opportunities, to us, that's really compelling value.
You like the housing trade?
I think it's a reasonable trade, but I think the housing sector is so broken that it's going to take more than a couple of ticks down in interest rates to really unlock the pent-up demand that exists.
I mean, mortgage rates are up, obviously, since the Fed cut rates because of what yields have done. We haven't gotten the expected drop I think some were looking for in rates. I remember, you know, Diane Olick the other day was just talking about how mortgage rates were up like 27 basis points in a really short period of time.
But we're still underbuilt, right? That's the real historical problem. Since 2011, the housing starts trended down for a decade because home builders just did not want to put shovels in the dirt and take the chance to be caught out if another 2008 type scenario happened. And we really haven't recovered from that. So at a point when you have millions of millennials that are looking to actually spend money to buy their first homes and get out there, there's just no supply, right? So that's really the problem that we have to fix, and I don't think interest rates are really going to be the thing to do it.
What do we think about, Mike, financial stocks as we're going to be talking about earnings here at the end of the week? It's going to set the tone in some respects for what this season may look like, at least at the outset, and the space has done quite well. Some suggest you can't lose the financials if you want to believe that the bull market could continue to roll on at any kind of clip.
Yeah, so financials have done a little bit better recently, but it's been a really tough run. I mean, we've had an inverted yield curve for almost 2 years, and that's really tough for regional banks, definitely, which are trading 20, 30% below their long-term average. And there haven't been a lot of IPOs. So if you look at the bigger banks, I think Jamie Dimon was out yesterday saying that it needs to be easier for companies to go public, a little bit self-serving, but he's probably right. IPOs have been pretty slow, but there have been a few. And I think as we look into next year, you're going to see that these large pipelines actually come through. So in terms of financials in general, I think we have a contrarian, more positive view on regional banks, given the steepening yield curve. And credit metrics have been really good. We hear a lot of stories about commercial real estate issues and other delinquencies out there, but the reality is the underlying metrics have been pretty good. And what you have with regional banks is, again, 20, 30% discount to average valuations, and you're getting dividend, 4 or 5% yields in many cases. So I'd say we have a contrarian positive bias on that group.
Yeah. I get the argument that interest rates are going to be the thing to really drive the financial sector. And I think historically, again, that has been true. The net interest margin is the thing that really drives the show. But in reality, if you're going to play the financials, the G-SIBs are where you really want to be, because those are the companies that have the ability to collect those deal premiums on M&A activity. They're taking companies public. They're forcing mergers and acquisitions, those kinds of things that are very likely to happen following November's election with a much more favorable administration than the one that we currently have with Biden.
All right, we'll leave it there. Thanks, everybody. I appreciate it. Mike and Allie, thanks. Malcolm, we'll see you back here hopefully soon on our set.